Think $5 a day isn't worth much? Well, what if I told you it could grow into a life-changing amount of money even while you sleep? So in this video, myself and my AI assistant Tiara will show you exactly what happens when you invest $5 daily for 5 years, what that can compound into over decades, and the best investment options to make it happen. Plus, I'll also reveal how to turn this strategy into a long-term wealth plan that could make you a legitimate millionaire. Now, Tiara, I'm calling on you here. So where do you think that we should begin?
Let's start with the simple math.
Okay, fair enough. Granted, I just have to say math, it wasn't my favorite subject in school. But when it comes to money, math just doesn't lie. So that makes sense. Let's go ahead and start there. So if you invest $5 a day for 5 years, you're putting away $9,125 total. But thanks to compounding interest, that money doesn't just sit there, it actually grows. So for the sake of this video, we're going to assume that you did some very boring investing. Now keep in mind, boring isn't bad.
Says who? I
even made a video all about it that I'll share with you at the end of this video as well. But we'll assume that you invest in a low-cost index fund and get a 10% annual return, which, by the way, is the average stock market return over the last 100 years. Which means that your money grows to about $14,696. Now let's take a second to see what happens if you stop investing after those 5 years and just let your money ride. So after 10 years, it would grow to about $23,668. After 20 years, it skyrockets to $61,388. And after 30 years, it explodes to a whopping $159,226. So if you really think about it, that's kind of insane. Right? That's over $150,000 from just $5 a day for 5 years. And this really drives home why starting early and choosing the right investments is so crucial. Even a small change in your annual return can actually make a huge difference over time. Oh God.
That's a real man.
Now I know what you're thinking. This is great and all, but where can I get these kinds of returns? Well, stick around here for this coming section because we're going to dive deep into some of the investment options that could possibly get you to $150,000 much quicker.
Let's talk about where to actually put that $5 a day.
So let's start with the safest option. And I just have to say it, that's talking to a professional because this video right here is not financial advice.
Oh, right. Because you can't trust yourself with your money. So you pay some guy in a suit to for you.
Language, Tiara. My God. Language. All right, so assume that you want to be educated, which this video is, right? We want to start with a high yield savings account because your money is safe, but it's not exactly growing fast. So on average, these accounts, they offer annual percentage yields of about 4% right now. And that's better than a traditional savings account, but still it's pretty modest considering inflation is typically about 3%. So there's almost no risk here, right? Your money is insured up to $250,000 by the FDIC. So even if the bank goes under, your cash is protected. But the downside is inflation can outpace your returns, meaning that your money might actually lose purchasing power over time. So next, we're gonna go ahead and step into the stock market.
Welcome to the casino, bitches.
Oh, Tiara, I'm sorry. Okay, so Tiara, it really isn't that bad if you know what you're doing, right? So index funds and ETFs, they're great because they spread your money across hundreds of companies, giving you instant diversification. Now, in terms of risk, while these funds are less risky than picking individual stocks, for instance, they do still, they're tied to the market. So if the market dips, your investment will too. But over time, historically, they tend to recover and they grow at a rate of about 10% each year, assuming you get into a broad market index fund. Now let's focus on micro investing apps next, like Acorns, which link in the description, that are really perfect if you're just starting out. So Acorns, it lets you invest small amounts regularly, often into ETFs or index funds, and you can expect returns similar to those funds, probably around 7 to 10% annually, depending on what you invest in, of course. But it makes the entire process extremely easy if you're intimidated by the stock market and you just want to kind of automate everything and forget about it. Now, the risk here is that it depends on what you're actually investing in through the app, as they do have different investment options. So you can either go with the least risky option with the lower potential return, or the most risky option with the highest potential return. But in all cases, these investments they are pretty safe overall. And they aren't just dumping everything into some new cat butthole meme coin on cryptocurrency, which it's not really a good investment. However, the fees can be a hidden danger here. So for example, with Acorns, if it were to charge you $3 a month and you're only investing about $20 a month, it's actually a 15% of your contribution being eaten up by fees, which is terrible, frankly. But if you're investing more, it's more reasonable. Now let's talk about the moonshot of the bunch, which is crypto.
Yes, crypto. You could end up rich, or you could watch your cash evaporate like your dignity at a frat party.
All right, you know what? That was actually a pretty good one, Tiara. I'm sorry. Anyway, cryptocurrencies like Bitcoin or Ethereum, they have seen insane returns, like over 100% in some years, but they can also crash really hard. So average annualized returns for Bitcoin have been around 110% historically, but there's been massive volatility and a short history. So this is definitely the high risk, high reward territory, right? Prices, they'll swing wildly based on hype and speculation rather than tangible value. Now you could double your money, or you could lose half of it literally in a matter of days. It's happened. So only invest what you're comfortable with losing here, as that just may happen. But for the record, I'm bullish on Bitcoin specifically. And if you think you have the money to, throw into it, invest for the long term, in my opinion, you'll be okay. But, we'll see what happens. So now that we've explored these options and their risks or returns, here's the big question. How do you balance these choices to create a portfolio that works for you? So stick around here because I'm going to show you how we can actually put this all together.
Now let's talk about something super important. Diversification.
Yeah, diversification is super important. I agree, Tiara. All right, so what exactly is diversification? Well, it's basically not putting all your eggs in one basket. So instead of throwing all your money into one type of investment, you spread it out across different options. Now, why is this so important? Well, imagine if you put all your money into crypto and then the crypto market just crashes. Well, that's not good. But if you spread your money across different investments, you're not going to lose everything if, one area takes a hit. And here's the cool part. Diversification isn't just about protection, right? It can also help you capture gains from different areas of the market. So for instance, maybe stocks are having a rough year, but your Bitcoin and Ethereum holdings are doing great. So by diversifying, you're actually giving yourself more opportunities to grow your money. Now I know what you're thinking, but how do I diversify with just $5 a day? It's not much money. Well, even with small amounts, you can still spread your investments. So for example, you could put some of your daily $5 into a index fund that covers the whole market, right? And then some of it could go into high yield savings account for safety. And then another portion could go into micro investing apps and maybe a little bit into crypto if you're feeling up to some extra risk. So the key is to find a balance that matches your goals and how much risk you're comfortable with. And here's a pro tip that'll help you out too. As your investment grows,
Trim the bush before it grows wild.
Oh, Tiara, seriously, just knock it off. Sorry. So as I was saying, as your investment grows, you should keep adjusting your mix to stay diversified. The correct term for this is rebalancing. And the idea is pretty simple. Every now and then, maybe once or twice a year, you'll want to check in and rebalance. This means selling a bit of what's grown a lot and buying more of what hasn't grown as much. So by doing this, you're essentially selling high and buying low, which is exactly what you want in investing. Plus, it keeps your risk level reasonable because it makes it so that you don't have too many gains in one particular area, right? It's a simple habit that can make a huge difference in the long run. And just like how I mentioned earlier that I made a video about boring investing, well, I've also made a video about rebalancing because both of these concepts are, in my humble opinion, kind of cornerstones to good investors. And frankly, they're good videos that I created. So if you aren't too familiar with one or either of these concepts, you can click on them right here to be brought over to learn more. But before you go, please make sure that you subscribe to the channel to unlock financial success one AI chat at a time. Thanks so much for watching.